Welcome back. You're watching NDTV Profit, and this is the Portfolio Manager. And with me is Ashish Chaturmohta, who is the Executive Director and PMS Fund Manager at JMFL. Ashish, we were talking about the defense stocks before the break. Give me your rationale for some of the defense stocks we've seen in the last one quarter, basically with respect to the earnings which has come in some of the stocks in the Q3 is not been as bullish as the order book they have been carrying.
So so I think defense is a very big opportunity. We have to understand that the capital outlay in defense is going to be at 12% CAGR, and I think that this is going to be a 10 lakh crore kind of opportunity. In that, if you look at the Navy itself is going to be almost 3,82,000 crore kind of opportunity size. Guided missiles could be almost a 1 lakh crore kind of opportunity size, and fighter jets or jet could be an opportunity of almost 4 lakh crore. So I think this is a very big opportunity. We have to look into book to bill ratio of most of these companies. So they are at around 5 to 10 times. I'll give you an example. A stock like Bharat Dynamics, which is doing a top line of close to 2,400 crore, are sitting on an order book of almost 24,000 crore. So it gives a book to bill ratio of almost 10 times, and the revenue visibility is very strong. We believe this can lead to a 15 to 20% top line growth for at least next coming few years. And with a lot of indigenization which is taking place in the defense companies, this is resulting into operating margins going upwards. So if you look at one point of time, Bharat Dynamics used to do a 55 to 60% used to be indigenization, and rest used to be import. But today, if you look at it, is almost above 90%. It is indigenization. So that is leading to a lot of operating margins upside, and that's the reason almost 20-21% kind of operating margins we are witnessing in a public sector defense company, and this will result in a PE multiple re-rating happening for lot of these defense companies. Take an example of a company like Cochin Shipyard, where it did hydrogen fuel ferry inauguration a couple of days back. And if you look at it, is also into electric vessels. They are going to come over a period of time. So if you look at in Europe alone, almost 2,500 vessels are going to get into the EV space. And if that happens, then this is a very big opportunity size for a company like Cochin Shipyard. Globally speaking, India is having just 1% market share in the shipbuilding space. And if this number starts to improve, then that's a large opportunity size which exists for players like Cochin Shipyard or Garden Ridge or Mazgaon Dock. And that's the reason we believe defense is a big opportunity. It's not like what we have seen in railways, where we have seen a massive rally coming into these companies, but the top line is going to grow only 15 to 20%. So there was a significant amount of PE rating which happened, but earnings flow will take really long period of time to come. So this could be possibly because of low float. These stocks have done reasonably good. But in case of defense, we believe the structural opportunity is very large, and that will result into positive action coming into names like Bharat Dynamics, Hindustan Aeronautics Limited, or Cochin Shipyard, to say so.
How do you look at consumption basket? Because at one time it used to be a defensive stock. You're not as bullish at them. Many of them are trading at a very high PE as well. Do you see these stocks continue to trade at a PE despite the fact that they will continue 10-20% growth going on?
Yeah, so that's the reason why we are seeing a significant amount of relative underperformance coming from a large cap, FMCG companies, or even consumption names, except for names like Titan or Senco or Trend, which are actually showing some serious same store sales growth. Or a company like Titan or Senco, where we are seeing some significant amount of volume growth coming into play. But if you look at most of the QSR players or FMCG companies, they are not seeing very strong trend at this point of time, because either the rural consumption is at a back foot, or we are seeing some significant amount of manufacturing growth, but the multiples are still far lesser Obviously these are more cyclical, but at this point of time what markets are going to reward is the earning growth, and that earning growth part is missing in most of these FMCG companies or consumption companies, whereas the multiples are at significantly higher level, and that's the reason we believe this consolidation can continue for consumption companies. But yes, exceptionally we believe companies like Titan, Trent, or for that matter companies like Senko, or in the QSR theme, we think a company like Vector Food, which is a proxy to the QSR theme, can be a good play. But in general, we believe that this theme is going to enter is into a consolidation phase, and it will take reasonable amount of time for them to show some strong earning growth momentum.
Final question to you, and quickly, because you have nearly 40% of portfolio in mid cap and small cap, and we've been seeing a lot of regulatory action coming for the mutual fund industry because of the kind of flows that are coming into this. What is your way of looking at your portfolio where you have a significant amount in small and mid cap in terms of stress testing of your portfolio?
So we have done a stress testing, and we have seen that most of the stocks which we are holding have a very good liquidity, strong earning growth momentum is there, and we also did one more test that what is the percentage allocation which is there into stocks beyond BSE 500, and that's where we find it very comfortable that we don't have a significant amount of allocation into stocks beyond BSE 500, and I think stocks between 200 to 500 which are part of the small and mid cap have a very high liquidity, strong capital base, I think, and with strong earning growth, and with a lot of large MFs holding these positions. At least we are comfortable holding those kind of names. But yes, maybe 5 to 10% of the portfolio could be aligned into stocks beyond BSE 500. So there we are always prepared. And as I say, this is the FTPM approach where we will take a call if we see some serious trend reversals coming into some of these names. So we will not hesitate to cut our positions in case if we find some dent. But at this point of time, we are very comfortable with most of the stocks we are holding in our portfolio.
All right, Ashish, it was a pleasure talking to you today. Thank you very much for joining us. That was Ashish Chaturmohta, who is the PMS Fund Manager at JMFL, and you're watching the Portfolio Manager. Thank you for watching today.